Are you ready to buy a business but aren't sure where to start to get your loan approved? In today's video, I'll walk you through a couple critical documents that you need to know before approaching a lender. Knowing this up front can save you time, reduce stress, and make sure that you get the loan approved fast. Well, fast is relative when coming to the SBA, but fast enough. Whether you're a first-time buyer or an experienced entrepreneur, this guide will walk you through and give you an edge you need to succeed. So stick around and learn exactly how to prepare and present yourself as a serious buyer. The first thing you need to do and get together is your personal documents. These are crucial because they show the bank you are personally ready for the financial commitment. A personal financial statement is likely the very first document a bank's going to ask for. This form is used by banks to evaluate your financial health. It includes your assets, liabilities, and your net worth. Think of it as the bank's way to figure out how capable you are of taking on the new debt. The last 3 years of personal tax returns. Banks need to see stable, consistent income history. This is why they ask for your last 3 years of tax returns. Stability reassures the lender that you're not a risky investment. Next will be your resume. You'll want to highlight those skills and the experiences that show that you're capable of running the business you're looking at buying. You'll want the lender to feel confident in your abilities, and that goes to show them that you have the experience and the expertise. Next is your credit score. Your credit score shows how you manage debt and how likely you are to pay on time. Now let's talk about some documents that you need that are related to the business that you're buying. Just like personal documents, these are equally important to present to the lender in a clear, factual way. The last 3 years of business tax returns. This will give the lender a detailed picture of how well the business has been performing that you're looking at buying. They'll also want to see current year-to-date income statements, balance sheets, as well as the last 3 to 5 years. This shows where the business has been and where it stands financially. And it gives the lenders a really good picture of, again, where the business is financially. Lenders want to see that the business has been doing well and is still doing well before they're looking at investing into you as a loan. This goes back to the last 3 years financial statements, or sometimes 5 years. This is broken down in monthly and helps the bank conduct a trailing 12-month analysis to spot trends and patterns. Additional key documents to have ready aside from the basics. There are other documents that you need to smooth out to show the loan process, and this will be based on the bank, so you want to talk with them. But here's just a few. Ownership breakdown. You'll need to clearly explain who owns what percentage of the business. This includes any spouses or guarantors that you may have on the deal. They'll want to see the letter of intent or asset purchase agreement that outlines the terms of the purchase and shows that both parties are serious and have agreed upon a purchase price and what those terms are. They'll want to see the broker listing or SIM. This is a document that's usually compiled by the broker and provides an in-depth information about the business, including financial, operational details, and more. They'll want to also see add-backs. What sort of adjustments or recasting has been done to make sure that the cash flow supports the debt that you're looking at taking on. For example, if the business had one-time expense that won't happen again, you'll want to add that back into the cash flow to calculate seller's discretionary earnings. The bank will need a list of what these add-backs are and supporting documentation to justify them. Next is the financing breakdown, sources and uses model. The sources and uses model is what helps you and the bank understand how the funds for the acquisition will be used. It's important to break down exactly how much money is going towards the purchase price, the SBA loan, seller financing. The bank will want to see that the debt service coverage ratio, or DSCR, is higher than at least 1.25, maybe 1.3, depending on the bank, to ensure that you can repay the loan. And that's based off of debt service ratio being calculated after you pay yourself a livable wage. Now, are you considering buying or selling a business? If you're considering either buying or selling a business, reach out to me to find out how much that business is worth. I'll do a business appraisal on the business, and in particular, if you're looking at selling a business, I can help take that to market, and you never pay me a penny up front. I only get paid when and if I find a buyer and we close on the transaction. It's a 100% win-win situation where my success is dependent on being able to do what I say I can do. So there's no other obligation or commitment on your part. If you're interested in potentially selling your business, use the link in the comments below and let's set up a time to talk. I look forward to working with you. Thanks.